Okay, good morning. So this is chapter 4 of Property, Plants and Equipment, financial statements of limited companies. So what my plan is as usual to go through the slides. I will do the examples in the workbook, and then recommend the exam kit questions for you to have a go at. So let's get into it. I mean, if you've come through level 3, you have seen some elements here. Certain elements here are elements of depreciation and things like that. So really, this is kind of structuring it a bit more, if you like. Let's just see. Pen seized there for a second. Right. So what are we talking about? I mean, give it names. We just talked about the actual ideas. We just talked about property, and I actually think at level 3 we might just have mentioned IAS 16, but it doesn't really matter. The key point here is that international financial reporting standards and international accounting standards are designed to ensure that we recognize, if you like, property, plant and equipment as true and as fairly as possible. So it gives us guidance as to how we deal with depreciation, how we deal with evaluations, and how we disclose what we have to disclose when preparing a set of accounts. So really, you understand the core principles of accruals and the need for, if you like, prudence within the concept of property, plant and equipment, but we're just structuring it, or if you like, giving it a bit more technical, if you like, structure, if you like. I think that's a good way to talk about it. So it defines, defines clearly what assets or what non-current assets are. And here it says that assets are purchased with the intention for long-term use. So straight away we know that we depreciate because of the concept of the accruals, if you like, right? So if you buy an asset over 10 years, the accrual structure, the accruals wants you to recognize that you're pretty much selling off this asset over 10 years. You just bought a long-term piece of stock over 10 years. And the accrual structure wants you to recognize in that year the expense for that year, and that's pretty much just that. And that's why so technically what you're really recognizing as an expense, what you're calling depreciation, is just an expense. Is just an expense, really. So that's, if you like, really the whole purpose of depreciation, to satisfy the accruals concept. You can't generate revenue without expending something. Something must have had to cause that revenue. Then we talk about IAS 16. We'll also talk about tangible, just definitions, tangible non-current assets and intangible non-current assets. So we're kind of upgrading a bit now, if you like. We know that tangible non-current assets are, if you like, land and buildings and machinery, and we have intangibles, if you like, as patents, as you can imagine, in our very services sector. Copyright, licenses, patents, brand, these are all intangible non-current assets. Now, you would always have remembered even the accounting equation, A is equal to C plus L. These two things, every business starts off requiring some element of C and some element of L, and these two together, if you like, really are referred to, I mean, it's not here, but it's good that you know it, as capital income. All businesses will require this is the business study term, really. Money coming into the business is referred to as capital income. This money, this large amount of money. So imagine this is 10,000 and this is 90,000, and then 100,000 sits in the bank. This 100,000 is primarily meant to be used to buy non-current assets, and so this 100,000 becomes really capital expenditure. So capital income is invested into a business to acquire capital expenditure. You see, when you want to trade, you shouldn't be using money from the bank. I mean, you probably will have to as a first-time trader, but ultimately, when you start with your E, you really just go debit purchases and credit trade payables. You shouldn't really be spending money from the bank. So ultimately, if you like, that money that's first put into a business is what is used to buy, if you like, the non-current assets. And of course, not just buying the non-current assets, improving the non-current assets. And you can see here it says that capital purchases, if you like, so this sort of credit bank, debit building, credit bank, debit vehicles, these are recognized as assets on the financial statement. And then all other expenditure. So like I was saying, so A is capital expenditure. Every E we were discussing, it technically didn't even come from capital income. It came from just buying on credit and then selling in time to pay off, right? That's what we're really doing. So, I mean, this is level 4 now. So you can see straight away that when I buy E, I'm hoping that I will sell it and then get the money in time, because I'm going to sell on credit as well to then pay off the liability. That's kind of what we talk about as working capital or the real trade of the organization. One second. I'm just shutting the window there. So we now have revenue expenditure as being all other expenditure. So this is not about improving non-current assets. So we're just talking about day-to-day running of the business, goods for sale, wages, repairs, pretty much within the year, right? Pretty much within the year. We know what depreciation is, right? I mean, these are revision classes and the useful economic life. So you want to be comfortable with just being able to know that when we talk about calculating depreciation, it's cost minus residual value over the useful economic life, right? You're not going to use this asset. You're only going to use it so if you buy something for £10,000 and you're going to sell it for 4,000, well, you're only going to use 6,000 of it. That's what you're ultimately saying. That's why this residual value is important, because you're only using 6,000 of it, and that's the only bit you should recognize within your set of accounts. And of course, we have two methods, straight line and depreciation. I'm sure you're comfortable with what those are. And really, you just have to watch the formula, what they're being asked for you to do. Sometimes they give it to you in percentage form. Sometimes you have to divide it by the useful economic life. And if you're doing diminishing balance, you're pretty much taking a percentage of the carrying amount, or the carrying amount every single year. And I'm sure you're comfortable with the calculation. Pretty much it's depreciation. This is an expense, is it not? And then you have accumulated depreciation. So you've been seeing this before. This is not the first time, whatever it is. This gets brought down and brought down and brought down. So one second. So in your statement of financial position, you will always see something like, building and accumulated depreciation, right? And this is the debit and this is the credit. So the two are kind of connected together. We keep them separately in terms of the building, right, and accumulated depreciation, just because the same way we put purchases and purchase returns and sales returns, we leave them separately. We don't put them together. And again, like, this is a revision class, which is why I'm able to do this. So, and this is also coming into level 4. So these ideas of depreciation and accumulated depreciation you must have come across before. This one is the one you do at level 3 as well, but people, and I'm going to do the example in the workbook in a second. But really, we're really playing around here with T accounting, and they're asking you to create a disposal. When I say they're asking you to get rid of something. So really, you can open up a disposal account and then use a disposal account as your vehicle to sort things out, if you like to deal with things. So we use the disposal account to extract them, to get the non-current asset out of it, and then sell it. And it's no different to it's no real different to an income statement when you have revenue here and you have expenses here. I mean, ultimately, this is what your income statement is, your statement of profits and loss, ultimately, right? And I hope you can start to see the parallels, really, and the difference really is profit, right? If this is 1 million and this is 500,000, well, your difference is the profit. So it's really profit here, if you like, and opening up your capital to put the other side over here. So the key point is that I'll do an example here, but in terms of disposing, we would extract, we need to get rid of it, we need to remove the non-current asset from where it is, which is why we would credit non-current asset, right? To get it out of non-current asset, to put it in the disposal account. And then because it's not just the non-current asset we're talking about, the non-current asset has an associated accumulated depreciation. So there's an accumulated depreciation to do with every asset. So really you have something that looks like this. You have the asset, then you have the accumulated depreciation. You might have something 10, and you might have 5. So right now the net book value is 5. If we're getting rid of this thing, well, I'll just change my pen color for a second there. If we're getting rid of this thing, we need to take this out as well as this. We can't take this and leave this in there. These two are connected. You might as well have one asset that just says net book value 5, but we don't keep this one that says net book value 5. We keep two separate assets. We keep two separate representations of the same thing. Joint representation of the same thing. 10 on this side, 5 on this side, ultimately giving us an average of 5. So what do we now have? We now have, if you like, we create a disposal account, and we take 10 out of here and we bring it here. We take 5 out of here and we bring it here. So you can see now this is done. There's nothing in here. The asset we're interested in is gone. Here it is. It's worth 5. We're willing to dispose of it, right? So we'll do a bit of that, and then we can finish it off, if you like, in terms of you'll now get some money for it. So really, ultimately, we're saying that this thing is worth £5, or 5 million, sorry, and then it's worth 5. So if it's worth 5, I'm always going to compare what I receive with it on this side, right? If I receive 3 for it, that means that 5 greater than 3, if you like, 2, whatever. But the double entry, if you like, you can see what they're telling you here, is to debit bank and credit the disposal. And whatever the difference is must be profit, right? If it's greater, then that's a gain. If it's less, it's a loss. And I'll do the T accounting on the other example, on the workbook, in the workbook. And they kind of, I think this comes up maybe in the in your workbook, where they ask you to actually do this is a T account. I always recommend do the T account yourself, and then you can plug the figures in to what's going on here. I mean, ultimately, this is really saying that that's the cost that's the accumulated depreciation. Those are the proceeds. And of course, the difference will be, if you like, profit or loss. And that's ultimately what you're doing over here. So you want to be able to do it comfortably on a T account, without doubt. That's what you want to be able to comfortably do. So I suggest, why don't we just quickly flick over, before we talk about revaluation, let's just flick over to that. Let's just do that question in the workbook, and then come back to revaluation. So it says here that Vintage bought a machine for £10,000. So we know that Vintage has a machine on the 1st of January in there for £10,000, and this is 2010. So be careful of the date, 2010. It said it depreciates the machine over 5 years with no estimated residual value. So we know, therefore, that's going to be 10, right? 10,000 over 5. So we know the depreciation is going to be 2,000 every year. And then it says that on the 31st of December 2012, Vintage decides to sell the machine. So, which means that if we're doing 31st of December 2012, right now we're in January 2010. So we have 2010 to December 2010. That's 1 year. 2011 is another year. 2012 is another year. So we've had this asset for 3 years. That means you must have built up accumulated depreciation of 3 years of 2000s, right? So that's 3 times 2000. So your accumulated depreciation is 6,000 over 3 years. That's what must have happened. I mean, technically, what am I saying? You'd have done depreciation, accumulated depreciation. I'm just doing this roughly. So you'd have done 2000 in 2010, 2000. You transfer this to the income statement, done. Then you'd have the next year, 2000 again, and then you add 2000 on here. Transfer to the income statement. This is 2011, by the way. And then 2012, exactly the same thing, 2000 and 2000 here. So you'd have had 6,000 build up over 3 years. Right. So what do we? Let me just give myself some space again. A second. So what are we saying? We are saying. Let me just get an eraser. Sorry. Let me just get rid of that. Sorry, let's give myself some space. So you can see that that's 6,000 anyway. The accumulated depreciation is 6,000. Okay, great. So let's carry on with this question. So if accumulated depreciation is 6,000, he said that you sold the machine for 7. So if you sold the machine for 7, we're really saying 7,000 came into the bank. Debit bank 7,000. Oh, sorry. Let's dispose. We're disposing of it. So the first thing I should do is create a disposal. Let's get rid of this thing. So if I'm going to get rid of this, credit 10,000 here, and then put 10,000 in disposal. Debit accumulates 6,000 and put 6,000 in disposal. And then it says you dispose it for 7. So if you sold it for 7, you have debit bank 7 and credit disposal 7. So just let's even thinking about it, it is currently worth 4, right? According to yourself, because you depreciated it by 6. The cost is 10. So it's currently worth 4, and you're selling it for 7. So you've made a profit of 3. So in your head, you know what your profit should look like. But the double entry requires us to do this whole disposal sort of process. So you have your, if you like, your disposal account, 10 here, 6 here, debit bank, credit disposal, which means that you have a profit, right? Because you can't keep the disposal account, there's no brought down or carried down with that. We're just simply using it to calculate our profit for the year on the disposal. So what do we now have? We have 10 minus, well, we have 6 here, we have 7 here, so that means we've made a profit of 3. So if you like, you can put SPL 3 here, and therefore your other T account, because there must be a T account to end this, right? So it's debit disposal and therefore credit. I'm just going to write this over this, credit gain on the sale of 3,000. It has to be a credit. It's a gain. It's a credit, right? It's a credit. So so that's how you deal with your disposals. This has been done at level 3. Please do it again. Make sure you're sure about how to make sure you're comfortable with dealing with disposals. Okay, great stuff. This is 16 minutes is a long time, so we'll carry on with revaluation in the next video, or the second part of this chapter.